The UK housing market, long regarded as one of the most stable and lucrative sectors of the economy, is currently undergoing a period of unprecedented change that is impacting buyers, investors, and homeowners alike. At UK Property Info, we have been closely analysing the latest data, trends, and market behaviours to provide viewers with a clear understanding of the forces shaping the market today. The first shocking shift, and arguably one of the most immediate and visible, is the rapid decline in house prices across key urban centres and high-demand areas. While national averages may suggest a modest correction, localised data paints a very different picture. London, which has historically driven property market trends across the UK, is experiencing significant year-on-year declines in both central and outer boroughs. Prime central London areas have seen reductions exceeding 10%, while many outer boroughs and commuter belt regions have adjusted downward by 5 to 7%. These figures are not just statistics, they reflect a structural change in buyer sentiment, affordability constraints, and evolving investment behaviours that have profound implications for anyone considering entering the market. This decline is not confined to London. Regional cities such as Manchester, Birmingham, Leeds, and Edinburgh are also experiencing sharp corrections, particularly in high-value neighbourhoods that were previously insulated from volatility due to strong historical demand. In these areas, annual price reductions can range from 5 to 8%, highlighting a shift in market dynamics that underscores the importance of localized knowledge. Buyers relying solely on national data may underestimate the magnitude of these changes, leading to overpayment or negative equity if they purchase without understanding neighborhood-specific trends. These declines are driven by multiple factors, including rising interest rates, tighter mortgage lending standards, and a cautious investment climate that has reduced the number of active buyers competing for properties. The second shocking shift is the dramatic transformation in mortgage affordability. Following a decade of historically low interest rates, borrowing costs have risen sharply, fundamentally altering the financial calculus for buyers. Lenders have responded by tightening criteria, demanding higher deposits, more robust income verification, and stronger credit histories. For first-time buyers, this represents a significant barrier to entry. Properties that were affordable just months ago are now potentially out of reach for many households, with monthly repayments increasing substantially. The ripple effects are clear: reduced buyer activity slows transaction volumes, and sellers are forced to adjust asking prices downward to attract interest. In addition, many existing homeowners with variable rate mortgages face uncertainty about future repayments as interest rates remain elevated, adding to the overall financial stress within the market. The shift in mortgage affordability is reshaping buyer behavior and influencing decisions across all segments of the housing market, from first-time purchasers to seasoned investors. The third major shift is the ongoing transformation of the rental market. Rising mortgage costs, increased taxation, and stricter regulations have led a growing number of landlords to exit the sector, particularly in urban centers, university towns, and high-demand neighborhoods. This reduction in rental stock has driven up rental prices, making it more challenging for tenants to save for deposits or transition into homeownership. For investors, the implications are equally significant. Lower rental availability reduces potential yields and increases risk, making buy-to-let investments less attractive and slowing the flow of capital into the property market. This contraction also indirectly affects first-time buyers, as fewer rental options limit their ability to enter the housing ladder, reducing demand for starter homes and contributing to downward pressure on property values. Construction and new build development trends represent the fourth key factor shaping the market. Historically, new construction served to balance supply and demand, moderating price fluctuations and providing buyers with a broader range of options. Today, rising labor costs, volatile materials prices, and tighter financing for developers have slowed or even halted many projects. This reduction in new build activity has a twofold impact. Limited supply increases competition for existing properties in some areas, while uncertainty about future developments reduces predictability for long-term planning and investment. Buyers must now consider not only current availability but also projected new developments, delays, and cancellations that could impact supply and future property values. Without careful research, prospective homeowners may purchase properties with limited long-term potential or miss opportunities in areas that are set to experience growth once construction resumes. Macroeconomic pressures add another layer of complexity to this evolving market. Rising living costs, including energy bills, transportation, and daily expenses, are reducing disposable income and constraining household budgets. Even households with fixed-rate mortgages are facing higher repayments upon term expiry, and wage growth in many sectors has lagged behind inflation. These economic constraints are influencing both affordability and buyer confidence, slowing transactions, and reducing the pool of active participants in the market. Demographic trends further exacerbate this situation. Younger buyers, burdened by student debt and rising living costs, are delaying home ownership, while older homeowners are increasingly reluctant to downsize or relocate, limiting the availability of larger properties for first-time buyers. This demographic imbalance, combined with affordability challenges, rental market transformation, and construction slowdowns, has created a market environment that is more volatile, less predictable, and significantly more complex than many buyers may anticipate. Psychological factors and market sentiment also play a pivotal role in amplifying these shifts. Media coverage highlighting falling house prices, rising mortgage costs, and rental shortages has influenced buyer and seller behavior, creating feedback loops that accelerate price adjustments. Buyers often delay purchases in anticipation of further declines, while sellers preemptively reduce asking prices to attract interest, magnifying volatility and accelerating downward pressure on property values. In high-demand urban areas, sentiment-driven behavior can dramatically influence short-term price movements, underscoring the importance of understanding not only data but also perception and expectation. Regional disparities further highlight the need for localized analysis. While some suburban and commuter belt areas have shown resilience due to relative affordability and continued local demand, urban centers and high-value districts are experiencing sharper corrections. Each micro-market, whether defined by city, neighborhood, or even street, exhibits unique dynamics that can dramatically impact property value, liquidity, and long-term potential. Buyers must investigate local employment trends, infrastructure projects, transport connectivity, and school quality to fully understand the risk and opportunity within their target areas. Ignoring these nuances can lead to costly mistakes, even if national averages appear more favorable. In conclusion, the first segment of this analysis emphasizes the complex interplay of factors driving the first of the 5 shocking shifts in the UK housing market: the rapid decline in house prices, coupled with transformed mortgage affordability, rental market contraction, construction slowdowns, macroeconomic pressures, demographic shifts, market sentiment, and regional disparities. For prospective buyers and investors, navigating this environment requires meticulous research, strategic planning, and a clear understanding of both immediate market conditions and long-term structural dynamics. Awareness, diligence, and professional guidance are no longer optional. They are essential tools for anyone seeking to make informed, sustainable, and financially sound property decisions in the UK's evolving housing market. One of the most significant structural changes influencing the market today is the slowdown in new build construction. Historically, new developments acted as a stabilizing force, providing additional supply to meet rising demand and moderating price growth. However, rising labor costs, volatile building material prices, and tighter financing conditions for developers have slowed or delayed many projects. In some cases, large-scale development plans have been paused entirely due to financial and logistical challenges. This slowdown has multiple effects. Firstly, it limits the availability of new homes in high-demand areas, which can temporarily intensify competition for existing properties, creating short-term upward pressure on prices in some micro-markets. Secondly, it reduces predictability for long-term planning. Prospective homeowners and investors can no longer rely on the steady introduction of new supply to maintain market balance, making strategic decision-making more complex. Buyers must now research projected completion dates, development pipelines, and developer reliability to avoid purchasing properties in areas where supply shortages or delays may impact liquidity and future value. Investor behavior represents another critical factor shaping the current landscape. Institutional investors, who historically absorbed large volumes of property stock, have become increasingly cautious due to rising mortgage costs, tighter regulation, and lower projected rental yields. Individual investors, particularly those in the buy-to-let sector, are also re-evaluating their positions in light of higher taxation, reduced interest relief, and increased operational costs. The combined effect is a decline in investor-driven demand, which traditionally provided a buffer against rapid price declines in many urban centers. Reduced investor participation slows transactions, decreases market liquidity, and can exacerbate price adjustments in areas where supply exceeds the pool of active buyers. Additionally, lower investor confidence may reduce renovation and development activity, which further impacts the quality and availability of rental properties for tenants, creating a secondary effect on the broader housing ecosystem. The rental market itself is undergoing a dramatic transformation, which has direct implications for both buyers and renters. The exit of landlords due to rising costs and regulatory pressures has reduced rental stock across the country, particularly in cities with high student populations or historically strong demand. This contraction has driven up rental prices in many areas, limiting the ability of renters to save for deposits and slowing their transition into homeownership. For first-time buyers, fewer rental options mean that traditional pathways into the housing ladder are constrained, and competition for affordable starter homes may increase in certain locations. For property investors, the reduction in rental availability and rising costs of ownership reduce potential yields, making buy-to-let investments less attractive and increasing exposure to financial risk. This interconnectedness between rental market contraction, affordability, and investment returns underscores the complexity of today's property environment. Macroeconomic pressures further compound these challenges. Rising living costs, including energy bills, transportation, and daily expenses, are reducing disposable income and constraining household budgets. Even households with previously manageable mortgages face potential increases in repayments as fixed-rate terms expire and interest rates remain elevated. Wage growth, in many sectors, has not kept pace with inflation, limiting the financial capacity of potential buyers to enter the market. These economic pressures are particularly pronounced among younger buyers, who are burdened with student debt and higher living costs, delaying home ownership and reducing overall market activity. Older homeowners, conversely, are hesitant to downsize or relocate due to financial uncertainty, limiting the supply of larger properties for first-time buyers and creating bottlenecks in market movement. The combination of economic constraints and demographic dynamics has fundamentally altered both the pace and nature of property transactions, creating an environment of heightened volatility and uncertainty. Policy and regulatory changes continue to play a pivotal role. Adjustments to stamp duty, buy-to-let taxation, and first-time buyer incentives have reshaped both affordability and investment strategies. Landlords face stricter compliance requirements and reduced tax relief, while first-time buyers must navigate complex eligibility criteria for grants and financial assistance. Policy uncertainty influences both supply and demand. Reduced landlord participation limits rental availability, while potential buyers may delay purchases in anticipation of favorable government schemes or regulatory adjustments. Strategic understanding of these policies is critical, as failure to account for them can result in unexpected costs, reduced investment returns, or long-term financial strain. Another layer of complexity comes from market psychology and sentiment. Media coverage of falling house prices, rising mortgage costs, and rental shortages has a measurable impact on buyer and seller behavior. Prospective buyers often delay purchases, anticipating further declines, while sellers preemptively reduce asking prices to attract interest. This feedback loop amplifies market volatility and accelerates downward adjustments in both urban centers and high-demand regions. Market perception, therefore, must be considered alongside fundamental economic indicators when evaluating property opportunities, as sentiment-driven behavior can influence pricing and transaction volumes in ways that traditional data alone cannot fully predict. Regional disparities further highlight the importance of localized research. While suburban and commuter belt areas show relative resilience due to affordability advantages and continued local demand, urban centers experience sharper corrections, particularly in premium neighborhoods. Each micro-market, whether defined by city, neighborhood, or even street, exhibits unique trends influenced by employment conditions, infrastructure projects, transport connectivity, and school performance. Prospective buyers must analyze these local factors meticulously to understand short and long-term property value, resale potential, and risk exposure. Ignoring these nuances can result in purchases that underperform despite favorable national averages. In conclusion, Segment 2 emphasizes the systemic and structural forces reshaping the UK housing market. Construction slowdowns, changes in investor behavior, rental market contraction, macroeconomic pressures, regulatory complexity, market psychology, and regional disparities collectively create an environment of heightened risk and volatility. Buyers and investors must approach the market with strategic planning, detailed research, and financial prudence. Understanding these forces allows prospective homeowners to navigate uncertainties, avoid costly mistakes, and make informed decisions in a housing market defined by unprecedented complexity. At UK Property Info, our goal is to provide the insights, analysis, and guidance needed to approach the market with confidence, ensuring that every property decision is grounded in knowledge, strategy, and long-term perspective. Market psychology and sentiment are increasingly shaping housing trends. Media reports highlighting falling house prices, rising interest rates, and rental shortages directly influence buyer and seller behavior. Prospective buyers often delay purchases in anticipation of further price drops, waiting for a market bottom that may be slow to materialize, while sellers lower asking prices to attract interest, accelerating market corrections. These feedback loops can amplify price movements beyond what fundamental economic conditions alone would dictate. Urban centers and high-demand neighborhoods are particularly sensitive to sentiment-driven behavior, as minor shifts in perception can trigger disproportionate reactions in both pricing and transaction volumes. Buyers must consider both the data and the psychology surrounding the market, recognizing that perception, expectation, and media influence can significantly affect outcomes. Regional disparities further complicate market dynamics. While some suburban and commuter belt areas show resilience due to affordability and continued local demand, major urban centers experience more pronounced corrections, particularly in high-value neighborhoods that were previously insulated by investor activity and international interest. London, for example, continues to face declines in prime central areas, while outer boroughs and commuter regions experience smaller, but still significant, reductions. Regional cities such as Manchester, Birmingham, Leeds, and Edinburgh display uneven patterns, with certain neighborhoods correcting faster due to affordability pressures, limited rental supply, or weaker demand. Micro-market knowledge is essential. Buyers must investigate local employment trends, upcoming infrastructure projects, transport links, and school performance to make informed decisions. Without this granular understanding, even properties that appear attractive on a national level may underperform locally. Policy and regulatory shifts continue to have a profound impact on the market. Adjustments to stamp duty, buy-to-let taxation, first-time buyer grants, and landlord regulations directly influence affordability, investment potential, and market liquidity. For example, landlords facing reduced tax relief and increased compliance costs are exiting the rental market, creating a ripple effect on rental prices, tenant options, and buyer demand. Similarly, first-time buyers must navigate eligibility criteria for grants and incentives, which can change unpredictably based on political decisions and economic priorities. Awareness of both current policies and potential future changes is essential for buyers and investors to avoid unexpected costs or misaligned strategies. Failure to account for these factors can result in overpayment, negative equity, or diminished investment returns. Macroeconomic pressures continue to constrain market behavior. Rising energy costs, high inflation, and increased living expenses reduce disposable income, limiting the capacity of households to purchase property or maintain mortgage payments. Even those with fixed-rate mortgages face the risk of higher repayments upon term expiry. Wage growth lagging behind inflation further limits affordability, particularly for younger buyers, many of whom are already burdened by student debt and rising living costs. Older homeowners, meanwhile, are often reluctant to downsize due to financial uncertainty, limiting the availability of larger properties for first-time buyers and reducing overall market mobility. The interplay of these economic constraints with structural factors, such as limited construction and reduced investor participation, creates a complex and highly interconnected system in which small shifts in one variable can have amplified effects across the market. Investment trends are also shifting in response to these pressures. Buy-to-let investors face declining yields due to rising borrowing costs, regulatory changes, and increased operational expenses. Institutional investors, who previously acted as stabilizing forces by purchasing multiple units and absorbing excess supply, are exercising caution, reducing acquisitions, or delaying portfolio expansion. The combined effect is lower liquidity and slower transactions, which can exacerbate downward pressure on property values, particularly in urban centers. Buyers seeking investment properties must carefully evaluate rental yield potential, regulatory implications, and market stability to ensure that investments remain viable in a rapidly evolving environment. Affordability challenges continue to dominate market behavior. Rising interest rates, higher deposits, and increased monthly repayments have slowed buyer activity, while rental market contraction and limited supply have raised prices in certain areas. The interaction of these factors creates a dynamic where some buyers are effectively priced out of the market, while others are forced to compete for fewer available properties, amplifying localized volatility. In this context, strategic planning and careful financial analysis are essential. Buyers must stress test their budgets against realistic worst-case scenarios, consider future interest rate fluctuations, and account for potential policy changes that may affect affordability or investment returns. Regional and local factors further influence market dynamics. Micro-markets within cities, neighborhoods, and even individual streets can vary significantly in terms of demand, price trends, and investment potential. Factors such as local employment growth, infrastructure developments, school quality, transport connectivity, and community amenities all play a significant role in determining property value. Prospective buyers must conduct thorough local research to identify areas with long-term growth potential while avoiding regions prone to stagnation or decline. This localized approach ensures more accurate decision-making and reduces the risk of purchasing properties that underperform relative to broader market expectations. In conclusion, the final segment of this analysis highlights the complex interplay of sentiment, regional disparities, policy influence, macroeconomic pressures, and investment behavior, all of which amplify the thirst for shocking shifts in the UK housing market. Understanding these interconnected factors is critical for making informed, strategic property decisions. The market's current volatility underscores the importance of research, financial prudence, and professional guidance. Buyers and investors must approach the market with caution, balancing immediate affordability considerations with long-term structural trends, regulatory dynamics, and regional micro-market knowledge. At UK Property Info, our mission is to equip viewers with the insights, analysis, and actionable guidance needed to navigate this evolving landscape. Awareness of these final shifts ensures that prospective homeowners, first-time buyers, and investors can make informed decisions, avoid costly mistakes, and identify opportunities in a market defined by unprecedented change. Knowledge, strategy, and preparation are the essential tools for success in today's UK housing market, and understanding this final segment is vital to developing a comprehensive, resilient approach to property ownership and investment. By combining awareness of market sentiment, localized trends, regulatory dynamics, macroeconomic pressures, and investor behavior, buyers and investors can navigate uncertainty and secure positions that are both financially sound and strategically advantageous in the current housing climate.